All righty. So welcome. Thanks for joining us. My name is Mike Hanf. I'm a partner here at William Vaughan also. And first go round, Kate and I and several others focused in on the PPP loan. And then ever since December 27th, I've been focusing in on this employee retention tax credit. So the first thing we want to talk about is, so what's the big deal? Because the employee retention tax credit is really not new, right? So the CARES Act brought to light this employee retention tax credit, but in the original rules, you had to choose between either the PPP or the employee retention tax credit. And for the lion's share of companies, it was a very unique situation that the ERTC was better. So 99.9% of companies out there went down the road of the PPP, and we've kind of forgotten about this ERTC. So the big deal is, as of December 27th, the new CAA changed the rules. We can now do both. As Kate did mention earlier, we cannot use the same dollar for both PPP forgiveness and the employee retention tax credit, but to the extent that we have excess dollars during both covered periods, we'll kind of cover what those covered periods are. To the extent that we have excess dollars, we can actually get both. We can get the PPP
Right.
loan, get it fully forgiven, and get the employee retention tax credit.
Oh, is she telling if she had
Um,
symptoms
the
now?
group health care plan expenses. So when we think about wages um, to the employees, the healthcare expenses are also included. And one of the other big changes is in the beginning, if we had furloughed somebody and continued to cover their healthcare, there's uncertainty whether you had to be paying them to stay home and then the healthcare could be included, or if you weren't paying them, did the healthcare still get included? And they actually clarified that. So, but the big change here is we can actually go back in time and do both. So since we can go back in time and do both, let's have a reset on, so what was this originally? What was it for 2020? And actually, as we sit here in the first quarter of 21, what are we actually allowed to go back in time and determine that we would have been available, or we would have been eligible for, and so we can actually go back and get it. So the employee retention tax credit, it's a refundable payroll tax credit. So a couple things there. It's refundable. So even if it exceeds your taxes owed, you still get a refund for it. And it's a payroll tax credit. So you're going to apply for it in your payroll tax forms, your 941 versus your income tax forms, whether that be 1040, 1120, 1065. So it's a refundable payroll tax credit. And it's for the qualified wages. We're going to go over what kind of gets us to be qualified wages, but the qualified wages paid to employees. So essentially March 13th to 12/31. So after March 12th and before January 1. So for each employee, we are capped at $10,000 for that period of time, March 13th to 12/31. And our refundable tax credit is 50% of those eligible wages paid to the employee March 13th to 12/31. So when all the dust settles for the 2020 calendar year, the maximum that you can get per employee is $5,000. Now, $5,000 might not seem like a lot, but you can start doing that math as far as if you have 10 people, right? An extra $50,000 is pretty darn meaningful. And you just kind of do the math from there. 50 people, 100 people. The numbers really add up quick, even though $5,000 might not seem like a lot. All right, so what's at stake is a potential for $5,000 per employee. So how do we qualify? Well, we want to think about how we qualify in two very distinct ways, because this is an or, not an and. So all we have to do is qualify under one of the paths. And think about one path being this operational path, so the actual business operations, and the other path really being more of a financial test. So let's cover the operational kind of path first. So to qualify, your business has to have full or partial suspension of its operations during any of the calendar quarters, during government or due to government orders, and those government orders need to limit commerce, travel, or group meetings. Now, I got another slide that goes into this a little bit more detail, so let's kind of pause on this for a minute, but essentially full or partial suspension is where government orders affected your business's ability to operate. So it's an or. So that's the operational path. If we don't meet that, we can still qualify under what's called the financial path, right? So the financial path is a significant, and this is a greater than 50% decline in gross receipts. So a greater than 50% decline in gross receipts for any calendar quarter in 2020 as compared to that same calendar quarter in 2019. Now, we got another slide here to kind of go over this. So I'll just go over the words here. So think of the greater than 50% gross receipts as turning a light switch on. So once we have a quarter that has a greater than 50% decline in gross receipts compared to 2019, the light switch gets flipped on. It doesn't get flipped off when our gross receipts come back above 50%. It gets flipped off when our gross receipts come back up to at least 80%. So it actually can be turned on for quite some time. So think of this company here that for quarter one had $100,000 of gross receipts, 2019. For 2020, it was 45. So we had a 55% reduction in the gross receipts, quarter one, 19 over 20, so we qualify. Quarter two, we have 150 over 112. Well, that's still not above that 80% threshold. Quarter three, 100,000 over 83,000. So now we're above that 80% threshold. But there's another nuance to how the rules are written. In quarter three, envision the light switch getting turned off, but it doesn't get turned off until the first day of the next quarter. So this particular company qualifies for quarter one. Now keep in mind, it doesn't start to March 13th, so it is not the entire quarter one, but starting March 13th of quarter one, all of quarter two, and even though we're at 83% in quarter three, they actually would qualify for all of quarter three. So basically a portion of quarter one, all of quarter two, and all of quarter three, this particular company would qualify for the employee retention tax credit under the 50% gross receipts reduction. So gross receipts, what are the gross receipts? It's kind of what you would expect. It is the total sales, less returns and allowances, but it also includes some things that you might not originally anticipate. So even if the business isn't in the business of investing, but just simply has some investments, so any interest and dividends for related parties that you're renting, so you're going to have to include the rents if you're getting royalties, and if you sold assets. So essentially all of the inflows to a business are going to be considered the gross receipts for that business. If that business did not exist for all of 2019, you start with whatever quarter they came into business in 2019 and extrapolate that for that quarter. So let's say that we're talking about the second quarter that ends June 30th, and we came into business as of June 1st. So we would take our June sales and multiply that by 3 and use that as our second quarter gross receipts. And then we would use that same number for simply the first quarter. So we would have actuals for third and fourth quarter. We'd extrapolate the second quarter and then just use our extrapolated second quarter for our first quarter. So even if we weren't in business for all of 19, there's still a potential to be eligible for the employee retention tax credit. So we've talked about being eligible, but we want to make sure that we're talking about the qualified wages here. All right, so hang on one second. All right, I am missing a slide here, but let me go over the concept. So the how to qualify, we've been talking about an operational pathway, and we've been talking about a financial pathway. Financial pathway is the gross receipts. The operational pathway is its full or partial suspension. Best to think about this in 3 different bullet points. So number 1, we have a government order. There have been instances where public officials have gotten onto the TV, they've got a press conference, and they've suggested or they've recommended the public do something or businesses do something. That doesn't qualify. So you got to make sure you're focused in on a government order. So once you're certain, okay, we have a government order, so then 2, the government order has to limit the commerce, travel, or group meetings, right? So the government order is going to limit my commerce, travel, or group meetings. 3, even if it is limiting those, it actually has to have an effect on your business. So I'll go through a couple of examples here. Take us, for example. Ohio didn't close down accounting firms or offices per se, but let's pretend that we're in a state where they did close down the offices. So we would meet the first test to say, okay, it's a government order that shut the office down. We'd meet the second test to say our office is shut down, so it's limiting our group meetings. We would not meet the third test because just the fact that we couldn't physically meet doesn't mean that we can't telecommute and do Zoom meetings, right? So we would not be eligible because we wouldn't be able to click off all three. If we were in a business, say maybe physical therapy, where we can't telecommute, right? If we can't literally touch and see our patients, then we're not going to be able to do that. So say a physical therapy office that wasn't allowed to come into the office, they would be able to qualify for all three. If you're in the restaurant industry, just like Kate mentioned in the PPP2, that it's 3.5 times, we're really focused in the restaurant industry for a lot of these things. And the ERTC focuses on the restaurant industry tremendously well in the sense of the simple limitation of tabletops qualifies as affecting the business operations. The IRS has a FAQ that actually walks through an example where a restaurant has the full takeout, has full outdoor dining because they can just have the outdoor dining. I'm just from a state that just allows that. And we have indoor dining, but simply because of the 6-foot rule, we have less tabletops. So even though we have full takeout and full outdoor dining, the having the indoor dining be limited does affect the business operations. So again, it's one or the other. Either it is limiting our business operations or we have a greater than 50% decline in cash receipts. So those are the two ways that we qualify. So if we qualify, then we're going to take the wages times 50% credit. So let's talk about the wages that we get to take times that math. All right. So full-time employee, and this is where it gets really, really muddy as far as comparing the PPP to the employee retention tax credit. For purposes of the employee retention tax credit, we want to make sure that we're looking at the only full-time employees, not full-time equivalents. And the rules are from the Affordable Care Act that it is the average of at least 30 hours per week or 130 hours per month. So we're going to go through, we're going to go back to 2019. We're going to go month by month and add up any individual that averaged at least 30 hours or any individual that had over 130 for that month, and we're going to add them up. Anybody that had 25 hours in that month and had 100 hours total does not count as a proportionate individual. It is only those individuals that are full-time employees. So we're going to, for 2019, we're going to go through and add up all the months and then simply divide by 12. If we are only in business for part of 19, we're only in business for 6 months of 19, we're going to do that by each month and then divide by 6. If we didn't come into business until 2020, we could still be eligible for the employee retention tax credit. And if we're in business for 6 months of 2020, we simply take those wages, divide by, or I guess take the full-time employees based upon the 30 hours and divide by 6. All right. So now let's say that our full-time employees is 150. So we're greater than 100. Your eligible wages that you get to multiply by 50% to get the credit are only those wages that we paid to people for people to stay home. So if we furloughed individuals, sent them home, and continue to give them a paycheck, we get to include those amounts. We're really not seeing where a lot of companies have done that. We are seeing where companies did send folks home and continue to cover their health care. This is the point I was making earlier as far as they clarified it, that even if they're not making a wage, the healthcare expenses still qualify as qualified wages. So the scenario we're seeing pop up here is an organization that is pretty large, say 500, 600, 700 individuals. So they're greater than the 100. So they haven't really paid a lot of people to stay home, but they did incur significant healthcare cost during whatever period that they qualified, and they're able to take that healthcare cost times 50% and get the employee retention tax credit based upon that. So where this program becomes very beneficial for an organization is if you're at or 100 full-time employees. So you go through your math and you've got 200 people that are 25 hours a week, they don't count, and you've got 90 individuals that are full-time employees. So now you get to play by the rules that are in the middle here that are average of equal to or under 100 full-time employees. So this basically is all of your wages. So everything that if you happen to be paying anybody to stay home, you get to include that. but you also get to include 100% of your wages paid to everybody. And also not the wages just to the full-time employees, but also the wages to the part-time employees. You just don't have to include those individuals in determining whether you're equal to or under 100 or over 100. All right, thing here that we just want to make sure we're noting, the PPP get to double dip. We get the forgiveness and we get to deduct it on our taxes. The employee retention tax credit, we do not get to double dip. So whatever amount of the credit is, we need to reduce our payroll deduction by. So if we had $100,000 of eligible payroll and we get a $50,000 credit, we're not reducing our payroll deduction by the full $100,000 of payroll that we got the credit on. We're only reducing our $100,000 of payroll deduction by the $50,000 credit that we got. There are quite a few exceptions as it relates to the wages that get to qualify for the credit. If you terminated an employee and you're paying them severance during the qualified period, that does not count. If you have more than 100 FTEs and you were paying people for like pre-existing items, say accrued vacation or sick time, that does not get to count. If you're at or under 100 FTEs, then accrued vacation time does count. You're also capped at kind of a pay that's the 30-day equivalency immediately before this eligible quarter that you're paying out the employee retention tax credit. You're not essentially allowed to pay somebody a bonus or a higher rate during the period of the employee retention tax credit. You can only pay them kind of what their normal pay is. Any related individual. Now, the way that the related individual rules are written, they're somewhat odd in the sense of the business owner still qualifies. The business owner's spouse still qualifies. It's just the business owner's parents, cousins, aunts, uncles, sons, daughters. So the owner and their spouse themselves qualify, but I guess the relatives, both older and younger, or I guess other aunts, uncles, cousins don't. All right. Also, Kate had mentioned that once we get the employee retention tax credit, those dollars cannot be also used for PPP forgiveness. There's actually a third category where the dollars can only be used once, and that's if you had this mandatory sick leave and you got a credit for amounts that you paid under the mandatory sick leave. That also cannot be counted for the employee retention tax credit. The PPP is coming out of the SBA rules. So we're in the SBA realm and we get to follow all the SBA rules. The employee retention tax credit is an IRS thing. So we're coming out of the IRS rules for the employee retention tax credit. And within the IRS rules, nothing new. There's nothing written in the code here specific to the aggregation rules. All these are pre-existing rules that we have to follow. And unfortunately, they're very, very complicated. But the two things that kind of catch people up are all the businesses that a person or a business owns more than 50% of would get combined together. And then also think of a group of 5 people. If a group of 5 people collectively own more than 80% of a business, and it's not quite that simple, you got to go through some other math, but if a group of 5 people own more than 80% of businesses, then those businesses have to be added together. So you add all your businesses together and you go through these different tests. Well, where is the test relevant? One, if you're determining whether you're full or partially suspended, you're looking at all the businesses. This actually stands to help the taxpayer, because if one of those businesses are partially suspended, then the entire aggregated group is eligible. The second way that the aggregation rules need to be applied is in the 50% test. You have to add all of the businesses together and compare all their combined gross receipts 2020 to 2019 to see if they qualify. And then the third way is within the full-time employees. We need to look at all the businesses together for 2019 to determine if the aggregation rules apply to us. So it's new. We can go back in time and get it, even though we got the PPP. It's capped off at $5,000 per person, which is 50% of $10,000 of eligible wages. We can qualify either via an operational pathway or a financial pathway. And we have a bit of an idea of, okay, so what are these wages that we're multiplying by 50% if we have a qualified period to get the credit? All right, so great. So let's say we go through all of that and let's just throw out that we got a credit coming of $100,000. Well, how the heck do we get the credit? It's not an income tax credit, it's a payroll tax credit. So step number one is you're going to look at your next payroll and you're going to look at those deposits that you're going to make with that next payroll. This is, and we've kind of done a little bit of research here. We can't find anywhere else in history where this kind of scenario has arisen. When you do your payroll, let's say on the next payroll, your 941 deposit. So this 941 deposit is going to be the employer, Social Security, and Medicare. Okay, well, that makes sense. That's the employer dollar. So I just get to keep my own dollars. But now we're going to take the employee Social Security and Medicare dollars, and we're going to keep those. That's the employee dollars. I'm not sure, that kind of makes me nervous, right? You get to even include the employee federal income tax withholdings. So you take all 5 categories there. So the employee and the employer dollars on the 941 that you would have deposited with the IRS if we have a $100,000 total credit coming and our next payroll has $10,000 of deposits, well, we just get to simply keep that $10,000. So we've now paid ourselves $10,000 of the $100,000. All right, so now we have 90,000 left. Where we're working through some strategy with some folks is to say it's easiest if you just get to keep your money. So let's say we've got $100,000 coming, $10,000 on the next payroll. All right, let's plan to keep our $10,000 for the next 2 payrolls. So we're gonna have 3 payrolls in total, keep $10,000 a piece. So now we have $30,000 that we've paid ourselves. All right, we're still left with $70,000 that we still are owed. There's actually a new form out there. It got created in 2020. It was new in 2020. So there's a new form they just recently, this past week, issued the 2021 revisions to this Form 7200. But essentially, it's a brand new form that it's basically advance on the employee retention credit. And so you fill out this Form 7200. It's a very simple 1-page form. You're going to fill it out, and at the bottom of it, you're going to put 70 grand because that's the additional amount you have coming your way above and beyond what you've already withheld via those 941 deposits. So it's either keeping your own deposits on the 941 deposits or filling out the 7200 is the way that you're going to get the employee retention tax credit. So everything we just got done talking about is the 2020 program that is unchanged from the original 2020 program. The big change is that we can do that and the PPP for the same period of time. In these changes, they also came through and really sweetened the program specifically for first quarter, second quarter of 2021. So all these rules I'm about to talk about only apply to first quarter, second quarter of 21 if the company is still eligible to get the employee retention tax credit in the first quarter of I guess 21. So first of all, they extended it to June 30th of 2021. Secondly, our 50% of qualified wages is now 70%. So for every $10,000, the max credit we can get per employee is $7,000. Secondly, for 2020, it was capped at $10,000 for the entire period of March 13th through 12/31. Well, now it's capped at $10,000 per employee per quarter. So we can actually get up to $14,000 per person of employee retention tax credit in the 2021, for the first 2 quarters of 2021. The 50%, greater than 50% reduction in gross receipts is now a 20% reduction. And there's a little nuance here that if you compare and that's, I guess I'd also need to clarify. So when you're talking first quarter of 21, you're comparing that to the first quarter of 19. So not the first quarter of 20, but first quarter of 21 compared to the first quarter of 19. If you happen to not qualify comparing the first quarter of 21 to the first quarter of 19, there's an alternative way that you can look at this. You can essentially look at quarter 4 of 2020 to quarter 4 of 19. And if the reduction is greater than 20%, then you are eligible for the first quarter of 21. So for quarter 4 of 20, to be eligible, it had to be the 50%, the greater than 50% reduction. You can actually get your quarter 1 to be qualified if your quarter 4 is greater than 20%. So I apologize. A lot of that is very, very confusing. So ask away, and we can certainly take some phone calls if you have some more questions too. I guess another item, 100 FTEs is now up to 500 FTEs. The rule preventing bonuses is now gone. So those are the changes to the employee retention tax credit for the first 2 quarters of 2021. The proposed bill coming through right now would extend the employee retention tax credit through December 31st. But again, that is just a proposed bill. So I do have some other tax changes, but I wanted to pause for a minute here and see, are there questions out there that we should be covering, Angie?
Yeah, thanks, Mike. That was a lot of really good
Yeah,
information.
I'm sorry, it's too much information, right?
No, I think it's all great. We all need to hear this. A question came through when you were talking about 2020.
Yep.
It said you have to take the credit in the same quarter in which your gross receipts are lower than 50%.
So yes, you can only take the credit in the quarter that you qualify. So you're either going to have to qualify because you had government shutdown, or you have to qualify because you had a greater than 50% gross receipts reduction. And so it's going to be your eligible, or your wages that are eligible are the wages that were paid during the period of time that you qualified, and you're going to qualify either via government shutdown or the 50%. So the credit has to come from the payroll in that period of time. But clearly, since that period of time has passed, we're going to have to probably file the 7,200, or actually a lot of folks are going back. I just don't like this answer. I'm hoping that the IRS gives us a lot better guidance. What folks are doing right now is they're going back and filing an amended 941X and asking for a refund for whatever particular quarter back in 2020 that they were eligible.
Okay, thank you. And this is a clarification. Now, you said a company not in operation in all of 2019 could qualify for the decline in receipts for the ERTC, or just the operational shutdown? Which would they qualify for?
Just the operations.
Okay.
Well, no, they could qualify for the gross receipts. So if you were in business, if you came into business in 2020, you can only qualify because of government shutdown. If you started business in 19, you would take the quarter that you started business and extrapolate that to make that a 3-month equivalent. So if you were only in business for a month of a particular quarter, let's say the 3rd quarter, we were in business for a month, we would take that month gross receipts, multiply that by 3 to get our 3rd quarter gross receipts. Then we would say, okay, that's our gross receipts for 3rd quarter. Use that same number for 2nd quarter 19, 1st quarter 19. We'd have actual for 4th quarter of 19. So now we have our 19 numbers set on our spreadsheet. Even though we didn't exist all of 19, that's how we would create our 19 numbers. Then we would compare those to our 2020 numbers to determine if we had that greater than 50% decline.
Okay, thank you. And then I had one last question. So it appears that businesses have time now to go back and determine if their ERC benefit for 2020, right? So how do you suggest a company deal with the requirement to add back wages on the 2020 tax return if they already filed the 2020 tax return?
Yeah, great question. So our current interpretation is, even if you are an accrual basis taxpayer, if you're a cash basis taxpayer, it's an easy answer. Even if you're an accrual basis taxpayer, if you have not actually applied for the credits, you have not received the credits, you do not need to worry about your payroll deduction on your 2020 tax return. You're going to go through and calculate those numbers. And even though they are based on activities that happened in 2020, you're going to treat that as a 2021 event. And so when you get those credits, when either you keep your deposits or you file a 7,200 and actually get a check back from the IRS, when you get those credits in 2021, you're going to reduce your payroll deduction on your 2021 tax return and not worry about your payroll deduction on your 2020 tax return.
Okay, great. So that's all the questions that I saw in the chat. But if there's anything else, feel free to go ahead and put that in there, and I'll keep monitoring that. I know we're at the end of our hour, but I appreciate that you and Kate can stay on because we still have, you said you had some other good tax changes you want to talk
I'll
about.
just kind of buzz through these real quick. So businesses, we had this mandatory sick leave. And so we were obligated as a business to pay the mandatory sick leave. And then we got reimbursed kind of the same way that we're getting reimbursed for the employee retention tax credits. So now under the new bill, basically it's optional. Businesses are not obligated to pay the mandatory sick leave, but if they do, they are still eligible to essentially repay themselves via the credits. The SBA in the first round actually made payments on behalf of SBA borrowers. They redid this. And so starting this month of 2021, SBA borrowers are actually going to get 3 months worth of principal and interest payments. There was actually clarification on this that I was really surprised by, but it's basically what the clarification is. So SBA pays principal and interest for a business. The interest that the business did not pay is actually still deductible. So much like the PPP, we get the money, we get it fully forgiven, we still get to deduct the expenses that PPP money went for. We actually still get to deduct the interest, even though the SBA paid that on our behalf. There's an additional $300 per week, so not the $600 that was in the first round, but there's additional $300 per week for unemployment benefits through March 14th of 2021. Charitable contributions, essentially there's just no limits on those. As much as you give away, you can essentially eliminate your taxable income on your 2021 tax return. Then also for business meals, businesses typically are only allowed to deduct 50%. So if you spend $100 on a meal, you only get a $50 tax deduction. So for all of 21 and all of 22, all of your business meals now are 100% tax deduction. On your personal return, the unreimbursed medical expenses, this was a 10% threshold. Now it's a 7.5% threshold, and it's a permanent change now. There's some credits that you get for energy efficiency. They're called Section 179. Those 179 credits are now permanent. There's also a thing called WOTC, Work Opportunity Training Credit, that was set to expire. That now is set to expire December 31st of 2025. Another item is employers could pay for qualified tuition up to $5,250 for an employee, and the employer still gets the deduction, but the employee does not need to record that as taxable income. So that's amended. Previously, it didn't allow the amounts that the employer was allowed to pay had to go for kind of current schooling. It wasn't allowed to go for student loan payments. They basically made it through the end of 2025 that under this Section 127 plan, the employer is able to pay student loan payments, and it will still qualify as a Section 127. That's it. Those are the items that were kind of the newer, just pure tax changes in the recent bill.
Okay, great. I didn't see any more questions through. We very much appreciate, Mike, both you and Kate being on here, and all through the last past year, being willing to do these webinars for us and providing all this great valuable information for the regional family business community. So thank you for that. Emily is putting in some of our social media links in the chat. We encourage everyone to like us, follow us, connect with us. We do try to Facebook Live these events. We recorded it. We will put it on our YouTube page, and we will send that link out. If there's something you want to go back and review, I know there was a lot of detailed content in here, or if you want to share it with someone in your companies or organizations, it'll be on YouTube within probably sometime this afternoon. So thank you everyone for joining us. As always, if you have any questions, feel free to message me. I can get that to Mike or Kate. And if there's any topics that's keeping you up at night or anything that you need some clarification on or you want us to address, let us know. We are a member-driven organization and we exist to help you. So if there's something you need to know about, let us know and we will put together a webinar or a panel or some type of event on it. So thank you everyone for joining.